Today's session is learning module number 4, and it is to address the closing process and what that entails from a bookkeeping standpoint. Not only just the physicalness of doing the closing process, but also understanding why we do the closing process. So the first thing that we're going to talk about is the accounting cycle, because the closing process is at the end of that cycle. And so what I want to do is I want to just kind of review the steps that you've done since the first day of class. Okay, so the first step in the accounting cycle is that you journalize the transactions. Okay. Now those are the business transactions in this particular case that the book gives you. It's also where you get to determine which accounts you're going to debit and which accounts you're going to credit. Once you've done that, you then are going to post those to the T accounts. Okay. And that's just taking what you've done in number 1 and putting it to either the debit credit side of the accounts. And then obviously you then have to balance those T accounts. All right. Step 3 is you prepare the first of 3 trial balances. And this is our unadjusted trial balance, and I'm abbreviating TB for trial balance. Okay. Remembering that trial balance is simply a way for us to make sure that debits and credits equal one another. And it's simply a list of the accounts, starting always with cash, ending with dividends, listing their balances, either their debit balances or their credit balances, and then adding it up. All right. So then number 4 is you prepare and journalize the adjusting entries. And those are to adjust any of the balances that aren't currently correct in the unadjusted trial balance. After you've done that, you then post to the T accounts just like above. Then number 6 is you prepare now what we call the adjusted trial balance. At this stage, you're now ready to go ahead and prepare the financial statements. So that's step number 7. Prepare financial statements. Once you've prepared the financial statements, you're ready to do your closing entries. Those are done once a year in the accounting cycle at the end of the company's either calendar or fiscal year. And I'm just going to write that is prepare closing entries. And we'll go over what those are here in a minute. Prepare closing entries. Number 9 is, and then you post those to the T accounts. Okay. And then number 10 is the post-closing trial balance. So this session is going to cover the last 3 steps in the accounting cycle. All right, moving along to take a look at the closing process. So the first thing that we want to take a look at is, what is the closing process and what does it mean theoretically? The closing process simply means bringing temporary accounts to 0. Okay? So the temporary accounts are income statement accounts and dividends. Permanent accounts or nominal accounts are all balance sheet accounts. All balance sheet accounts. And so the closing process affects temporary accounts. These are the ones that we're going to make zero. And the balance sheet accounts, with the exception of retained earnings, remain untouched. So they remain untouched. With the exception of retained earnings. Okay. So the purpose to close is to bring the temporary accounts to zero, or in other words, to zero out the income statements and dividends. In other words, reset them to zero so we can start the new year and start collecting the revenue and expenses and the dividend payments for that 1 year. Remember that our accounting cycle is 12 months, and so therefore we have to have some way to restart the new year. And that's the way we do it, is through the closing process. So now let's go ahead and take a look at what the entries are for the closing process. Okay, so let's go ahead and take a look at the actual closing entries and what they look like. So the first entry that we're going to make in the closing process is we are going to close all revenue accounts. Okay. And what that looks like is we're going to debit the revenue accounts. So if it's interest, you would debit that. And we're going to credit retained earnings. Okay. The second one we're going to do is we're going to close all expense accounts. And the way that we do that is we're going to debit retained earnings. And we're going to credit the expense accounts. The third closing entry is to close dividends. And the way we do that is we debit retained earnings. And credit dividends. So those are what the basic entries look like. Remember, to close is to bring to zero. So typically, revenue, and I'll show you that here in a minute, has a credit balance. Therefore, to bring it to zero, I need to debit it. Same with expenses, as they normally have a debit balance. Therefore, to bring them to zero is a credit entry, as well as dividends has a debit balance. So to bring them to zero also needs to have a credit. What we're doing is we're permanently now moving revenue to retained earnings, as well as the expenses and the dividends. And then so going forward to the new year will be a new retained earnings balance. And so what I want to do is go ahead and take a look at an exercise and walk you through the steps, visually looking with some numbers. And so we're going to be using exercise 21 on page 102. All right, so exercise number 21. The first thing that you should notice is that there's a trial balance listed here. And you can see we have the normal accounts, cash, all the way through dividends. their debit balances and their credit balances. And so I'm going to go ahead and take the income statement accounts, which you should notice here on the trial balance is revenue and 2 expenses, and then, of course, dividends, which is not on the income statement. But we're going to go ahead and make the T accounts that represent what this balance sheet is showing us. So the first one that I have is service revenue. Then we go ahead and we have the insurance expense. And then the next expense is salaries. And then we have dividends. Okay. I'm going to go ahead here also and list the retained earnings, because that's on the trial balance as well. And you can see that for here, you have a $2,380 balance in this account. Typically, in the problems that we've been seeing on Cengage, it's either been 0 and no beginning balance. So in this case, this represents the beginning balance in retained earnings. And so the service revenue number is $14,820. The insurance expense is $2,300. And then the salaries expense, I believe, is $89.20, and dividends is $1,200. All right. All I did was take the balances, put them in their T accounts, which is where the trial balance came from. It came from the actual trial balance, the T accounts. Okay. And so to close, so the first thing I want to do is I'm going to journalize the closing entry. And so that first closing entry would be to debit service revenue. And I'm going to debit that for $14,820. I'm going to go ahead and post that. And you can see now that the service revenue balance in the account is a 0. And then I'm going to credit retained earnings. So that's the first journal. And so then I'm going to go ahead and I'm going to add $14,820. And I'm just going to make a note for you all so you can kind of follow along with me. And R for revenue. All right. So now what we've done is we've closed the revenue account, we've brought it to 0, and we moved those revenues for the year permanently to retained earnings. Now we have to go and do the same thing for the expenses, which is that second closing entry. And so we know that the debit, based on the template I just gave you previously, is that I'm going to debit retained earnings. So in this case, I'm going to take insurance expense, and I'm going to credit it for $2,300. I'm going to take salaries expense, and I'm going to credit it for $89.20. When I add those two together, I get $11,220. Okay? And so that is the amount that I'm going to move here to retained earnings, and I'm going to post each of those, bringing each of these accounts to 0. So now I've closed the expenses and brought them to 0 as well. So for the third closing entry is a debit to retained earnings for $1,200 and a credit to dividends, $1,200. So $1,200 debit minus a $1,200 credit is going to give me a 0 in that account. And now I can't forget to go ahead and also post that to the retained earnings account. So here we know we have the expenses, and here we know we have the dividends. So if we go back to how we prepare a statement of retained earnings, we actually have that right here, don't we? because we know revenue minus expenses equals net income if revenues exceed expenses, or if expenses exceed revenue would be a net loss. So we also know that beginning retained earnings plus net income, so in this case, beginning retained earnings plus the revenue minus the expenses minus the dividends gives us ending retained earnings. And if we did the math here on that, we would get 4780. Okay? So if we do that formula, which is the statement of retained earnings, beginning retained earnings plus revenue minus expenses, and we know that equals net income, minus dividends equals ending retained earnings. If we go back to that formula for the statement of retained earnings. So what we're doing is we're permanently moving those to the retained earnings account. Once we've prepared the closing entries, again, to bring the accounts to zero, we have one more step in the accounting cycle, and that is to prepare a post-closing trial balance. And that's what we're going to do next. We're going to still use problem number 21 on page 102. Let's go ahead now and prepare the post-closing trial balance. So looking at page 102, exercise number 21, once again, you'll see the trial balance, and you'll look down, and you know now that the revenue, based on what we just did, that the revenue account is now zero, insurance expense is zero, salaries is zero, and dividends are zero. Therefore, in the post-closing trial balance, those accounts will never be on a post-closing trial balance. In other words, revenue, expenses, and dividends, or better yet, the income statement accounts, will never be on a post-closing trial balance. Your last number on a post-closing trial balance will always be retained earnings. So let's go ahead and prepare that post-closing trial balance. Okay. So I'm going to go ahead and list cash, which is the asset. Let me go ahead and put my glasses on so I can see. 4280. We then have prepaid insurance, and I'm going to abbreviate that with PPI, which is 3,500. We then go to the liabilities, which in this case is unearned revenue, and that's 3,000. It then jumps to retained earnings. Typically, you guys will have a common stock account or a capital account, but in this particular example, that doesn't exist. And so the last account that we have is retained earnings. Okay. And the number that they have there is 2380. And I'm going to put that down just for education purposes. So here we have 7780 when I total. If I was to total this credit side, you can see we only have 52,380. So right then and there we know we don't balance. And the reason we don't balance is, if you remember correctly, you have made changes to this retained earnings account. You have put revenues in it as an addition. You've subtracted expenses because you had to use that to bring the accounts to zero, and you've subtracted dividends. And this number on this trial balance does not represent the changes you made. And so what you need to do is you need to go ahead and come up with a new number. And that new number was the number that we just had on the board that was the retained earnings number. And so if I go ahead and I do that here, and I want to take that, let's go back and recreate that retained earnings T account. We started with 2380. We added 14,820. We subtracted 11,220 and 1,200. When we do the math on that, we come up with 4780 as the balance. And remember, what that is beginning retained earnings that they gave us, 2380, plus the 14,820, minus 11,220, minus 1,200, equals 4,780. That is the number that you put there, 4,780, and now we balance. And at this point, we're done. We're done with the accounting cycle. Remembering that the closing entries are only done once a year at the end of the either calendar or fiscal year for the company. We only do the closing entries one time. And we only do them to make sure that we reset the temporary accounts to 0. So let's summarize the closing process. Okay, so to close is to bring temporary accounts revenue, expenses, and dividends to 0. In other words, reset them so we can start collecting new information for the new year. Okay. Balance sheet accounts, untouched, except retained earnings, okay, and then we prepare a post-closing trial balance at the end, only balance sheet accounts. Okay. And that concludes the module on Chapter 4 on the closing process.